house. All right, forget it. We're done. No. We are going to talk about the state of the housing market with an expert. It's very exciting. I have to kill a little bit of time here because the crew's setting up and I want to be mindful of that. But I will just tell you, I met or encountered Bill just like Barry did when I was an investment advisor. And it was exciting because I found a guy who I could read and understand and actually be able to tell my clients like, hey, I think this housing market is kind of out of control. And so when Barry and Josh and Michael invited me here to interview somebody, Barry's like, you know Bill McBride? I'm like, the Bill McBride? Are you kidding me? He's amazing. So Bill McBride, welcome.
Thank you.
Very nice. Okay.
It's great to be here with you.
It is so much fun. Okay, so what is better than having that beautiful chart up? So one of the things I think is important is to explain to people that the housing market didn't just start in 2020. It actually goes back a little bit farther, right? You know, we have some context here. So Bill, can you talk about the chart that is in front of us, nominal house prices? And I think we started in what year is that, 76?
Yeah. So this graph is based on the Case-Shiller index. Really, a lot of people don't know that the Case-Shiller index really wasn't available publicly until about 2006. But now they published all of the data back to 1976. So this graph shows what happened with nominal prices. You can see the housing bubble in 2004, 2005, 2006, and then the subsequent housing bust. And one of the reasons people want me to talk is because we've had this big run up in the last few years.
And he's actually a little bit too modest, but Bill first started writing about the housing bubble in 2005-ish. Is that about right?
Yeah, January 2005.
And what led you to make that, besides, you know, everybody saw it. Everybody could see, oh my God, real estate's going crazy. Houses are going crazy. Who in this audience was like alive during 2005? Like it was insane, right? It was crazy. Like it was The Big Short, but that didn't even do justice to it. What was it for you, one of the few people who called it out a little bit early?
Well, it's interesting. I was working out at the gym. There was a young lady that I would talk to all the time. And she came in one day and she said, hey, I just bought this condo for $400,000. And I happen to know, because of our conversations, that she was making about $40,000 a year. And so my question was, well, how does that work? And so I started talking to her, and she was getting a 1% teaser rate on her loan. And at the same time, there were these guys in the gym. I call them the spiky hair guys. They were all driving these really nice cars, and they had spiky hair, and they were all in their 20s. And so I started asking them what they were doing. They were all mortgage guys. They were all, and they said, hey, you can get any loan you want. So I that's what really started me digging into it. And it was pretty grim when you got into the nuts and bolts of what was going on.
And I just want to do one thing. So I'm going to just change our chart for a second because, you know, so often with housing prices and real estate, we talk in nominal. That's how you get these people who say to you, like, my father bought his house for $20,000. It's worth $2 million now. But Bill, you are very clear that we need to really incorporate real house prices. And when you do that, we see the bubble peak, which was, I guess, 2005?
Probably 2006.
2006. We have a complete meltdown. How many times before the housing bust had housing prices gone down on an inflation-adjusted basis?
Well, even on this chart, it was twice before. So, house prices nominally haven't declined very much, but in real terms, like, I think a good example is what happened in the late 70s, early 80s when we had really high inflation. House prices actually dropped, depending on the measure you use, by maybe 10%, 15% in real terms. So, and what that means is people's incomes were rising, and even though house prices nominally were pretty flat, and so they became more affordable. Plus, of course, at the time, the mortgage rates dropped dramatically.
And I will say that Bill did share with me that I said, well, what was the rate of your first mortgage? And it was 11.1%.
Yeah, and I think I bought my first house in '79, 11.1% mortgage rate. And when I sold it just a few years later, that was a selling point because back then a lot of mortgages were assumable. Now there's only a few, maybe VA loans are assumable, but back then, so when I sold it, people were all excited they could get an 11% mortgage.
So I want you to describe a little bit about the market crashes. Just again, we're setting this up, gang. See, do you feel the momentum building? It's great. We'll get to today. We have the housing market bottom out in 12. Is that where it's like sort of the bottom is?
Yeah, late 2011, early 2012.
And was that when you were saying the future's so bright, I need my sunglasses?
Yeah.
Is that exactly what you said?
Yeah, I wrote an article in January 2012. People were still pretty bearish on housing. I said, the housing bottom's here. That got picked up everywhere because people were calling me the grizzly bear of housing. What's funny, I didn't tell Jill this story before, but there's a lot of people out there that make their living being bearish. And when I started writing my blog, which is called Calculated Risk, I was pretty bearish. So I not only was talking about housing, but I was talking about the potential for housing to lead into a financial crisis. So a lot of people were calling me a grizzly bear and super bearish. When I started turning positive, first on the economy in early 2009, I got a lot of angry emails.
Why? Why would anyone be?
Well, because they thought I was one of a kindred spirit.
Oh, so the perma bears came after you and said, no, we don't like that.
No, it was crazy,
How
actually.
dare you look at data?
And then when I called the bottom, saying, hey, the bottom is here, and I think that was January 2012, I got another big slew of emails. But on the flip side, in the next 2 or 3 or 4 years, I got some really nice emails. And people say, hey, I finally bought my house. Thank you very much. And every time I told them, I said, I didn't tell you to buy the house. You pulled the trigger. So, and all those people are really happy now.
When you look at that recovery period, so let's go from 12 to 20. What's happening in the housing market? Like, are things sort of resetting and getting more into balance? Is inventory coming back? Because obviously during the housing crisis, for some of you who are younger, anyone who was in construction and home building left the industry. There was no money to be made. They were going broke. They were finding other jobs. They were doing different things. What happened in those ensuing recovery years?
Well, from 2012 to 2020, it was just a perfect time for housing. The builders were very happy. Anything you built got sold. Home buyers were very happy because prices were going up. I think Ivy Zellman called it nirvana for housing.
Yep.
So it was just a really good period. As a matter of fact, I was just sharing with Jill. I said, well, maybe I'll just quit because it's too boring. But the last few years haven't been boring.
No, anything but. So we did have an incredible series of events. That catapulted the housing market to where we are today. So in March of 2020, the economy shuts down. And what's happening in I remember that in the very beginning, people thought no one would buy a house in the beginning of the pandemic, right?
I wasn't really sure what was going to happen. One of the things I really like to look at is housing supply. And actually, in March of 2020, housing supply was going up because here in California, you weren't even allowed to show a house. So people there was a several month period where the government wouldn't allow houses to be shown. So you had to, kind of buy them off the pictures. But then we had a couple of amazing things happen. First of all, demographics was great in 2020.
What do you mean by that when you say demographics?
We have a cohort going right into the home buying period. So the millennials, which is the largest generation in U.S. history, all of a sudden are hitting their 30s.
And that was the generation that many people said, oh, they don't want to buy a house. They're never going to buy a house. When everyone says never, you should start thinking, well, that's counterintuitive. Why would never ever be the case in a generation?
Yeah, it's funny. I was on TV, I think in 2012 or 2013, and I said, we're really going to get a boom in 2020, and people didn't care. so I said, oh, okay, nobody cares about what's going to happen 7 years out, but it did happen, and of course, at the same time, we've got a combination of fiscal policy that's very supportive of everybody. People weren't losing that many jobs, especially the home buying people, and then of course the Fed lowered interest rates to 0, and I have a number of friends that have mortgage rates under 3%. So
and so at that time, so we have like 2020. It's funny. I'm sure that we go back, we look at the data. It's 2020. It's really 2021 and 22 where you start to hear people saying they cannot find a home.
Yeah, well, even in 2020, by the end of the year, housing supply was dropping like a rock. And 2021, 2022, it's just no supply at all. So, now we're starting to see supply coming back on the market. So this is something that, of course, I watch every day. So,
and would you say from the residential market, the key is always going to be supply for the next group of years?
Yeah, well, the thing is, supply and demand works for economics, but demand's always a little bit harder to judge. So I always just really focus hard on supply. And recently, I've been looking at months of supply because we have this less than 4 million annual rate for existing home sales. And so we don't have to get back to 2019 levels of inventory. We just have to get back to 2019 or lower or higher, levels of supply, months of supply. And that's probably happening right about now.
And it's interesting because so Bill just mentioned, existing homes, 4 million, new homes, 1 million-ish, right?
Yeah, something a little less than that. But yeah.
I think a lot of people get confused. I say, well, where is it? Like, aren't there more people? Why are there not more listings? And Bill introduced me to this term called the 3Ds, because I said, why would anyone list their home right now and give up those 3 or 4% mortgages? Why would they do that? And Bill says, oh, well, there's always the 3Ds, which are?
Yeah, well, the 3Ds I actually got from my co-blogger, Tanta. If you haven't read my blog, there's links to all of her writing. She passed away in 2007 from ovarian cancer, but she was a phenomenal writer, a mortgage banker, knew the industry inside and out. And she told me that people always sell death, divorce, and disease. Nowadays, because of improvements in insurance, disease isn't as common a reason, but death and divorce. And then, of course, we added the 4th D during the financial crisis, which was debt. And we're kind of maybe seeing a little of payment issue right now in Florida because in Florida, homeowners insurance is a real crisis. It is in California too, but nothing like Florida. And also they're mandating at the same time that all these old condos, because of the condo collapse, they have to bring their maintenance, all the deferred maintenance has to be taken care of. So they're having special assessments on the owners. And a lot of people in Florida, their homeowners insurance is more than their mortgage.
That's insane. We're going to do a little quick poll. This is very scientific. Who thinks this is a good time to buy a house? Who thinks you're insane to buy? So who thinks, like, if you have the money, you run the numbers, go buy a house? Yes or no? All right. And who thinks this is a terrible time to buy a house? You're nuts. Bill?
Well, I'd be in the first group. I think housing is really hard to time. The only time in my entire career that I told people do not buy was in the late 2004, 2005, 2006, even 2007 period. To me, you're going to get a much better price because of all the distress sales that are coming on the market. Today, if you are out looking for a house and it makes sense, it's not on a busy street, you're going to live there for 5-7 years, it makes sense financially, I don't see it as a big problem. You shouldn't be expecting large appreciation, but that's not really why people buy a house.
Yeah, and I just want to talk a little bit about where we are with affordability. And this is maybe one way to sort of couch that, which is obviously with prices up, I guess, by about 50% since before the pandemic, and inflation's up, say, or prices are up generally by 22%. So house prices are growing about, 2.25 times the pace of inflation. So why should we buy? If I'm looking at this, I'm like, wait, maybe I should rent.
Well, like I say, I think it's really hard to decide that.
Yeah.
One of the things I've been arguing is, first of all, we have this great graph. We see this huge bubble in the middle. But if you're comparing to the housing bubble, the current situation, that's not the right comparison. In the housing bubble, we had really loose lending, and we got, like the lady I was telling you about that had a 1% a teaser rate. I think she had it for 2 years. And then I go, what happens after that? All of a sudden she can't afford her house. But so we had this flood of distress sales, and that's what really drove down house prices. So that didn't happen this time. Now all these people have tremendous equity, so we're not going to get a flood of distress sales. We may see prices drop in some areas, like I was talking about Florida. We're seeing some price drops there because of particular reasons, the homeowners insurance, which is related to climate change, and but we're not going to see a flood of distress sales. So this is more like, if you look at this graph, you can, this is price to end, but you could, that 1980 period, this is much more like that. And so what we should kind of experience is somewhat flat nominal prices, maybe some slight increases, slight decreases, but it'll just kind of stay there for a while. And that's where it shows on the real prices how after that period, it just kind of, it went down and then moved sideways for a while. And that's kind of what I expect this time.
I think that a lot of people here have their clients, they're coming to them and they're saying, well, should I just, buy a house for my kid? A lot of their wealthier clients, especially, and if you have a young client, I think the messaging here is, hey, you know what? You can buy a house, just make sure the numbers work. Make sure that you have confidence that you can support the payment. But how should people factor in this crazy insurance or even taxes, which are likely to go up in many areas?
Well, you want to look at all expenses. So, if you're buying a condo, you want to know what the homeowners insurance, the homeowners association fees are. You want to know if there's deferred maintenance. Right now the lenders are really tough on condos because of that. If you factor all of the costs in and it makes financial sense to you, I say go ahead. If it doesn't, then don't. Right. And I always caution people, and I'll say it again, don't buy a house that is in a really bad neighborhood. Don't buy a house on a big street. Don't buy a house with a layout that you absolutely hate, because you're going to hate it for the entire time you're there. So, I would never do that. But if you like a house, it's in a neighborhood that you're very comfortable with, and it makes sense financially, I don't see any problem buying now.
And is everybody here satisfied? Are we done? You're all okay with the housing market? We can move on? No, I'm just kidding. So when you look at where we are, I just want to go to that mortgage origination. So, by the way, let me just stop for a second. When Bill talks about supply, just check this out, like existing home inventory. Is this improving at all?
Yeah, well, this is raw inventory from the National Association of Realtors. So, you can see how inventory really surged during the housing bust, because, a lot of, it was not just people trying to sell, but the banks had a whole bunch of listings on the market. From that 2012 to 2020, inventory was kind of declining steadily. But then it just dropped like a rock. But this doesn't really capture everything, because this is just inventory and not sales.
And so if we let's now go over here.
Yeah, here we
go.
Yeah, this shows you existing months of supply. So the lines at the top, that's 2017, 2018, 2019. You can see the black line, which is 2020, where I was saying the inventory all of a sudden surged,
right,
and then dropped like a rock. And then the last 3 years, we've had pretty low inventory. And the red is this year. And so we're getting back to a much more normal level of months of supply.
So if you had to describe your your sense of where we are in housing today as we, come into the last quarter of the year, and we'll get our first rate cut tomorrow. And you're not a perma bear. Are you bullish? Like, how would you characterize yourself?
Well, I'm definitely not bearish. I'm not a super bull like I was in 2012. I do think the home builders should be okay. This whole sequence has actually been somewhat good for them because there's no existing supply or very little existing supply competing with them, and home builders have tools. They can buy down the mortgage rates. There's this pretty well-known 3-2-1 program where they buy it down for 3% the first year, 2% the second year, 1% the third year. And then, of course, they were always telling people, buy the house, but don't date the rate so that they'll be able to refi in a few years. So, but for the existing home market, I kind of expect that we'll be moving a little bit back towards normal, but it's going to take some time.
How much time? I'm going to make you just tell us exactly so I don't have to think about it.
Well, that brings up a really interesting issue is my generation will, if my generation follows the generation, my parents' generation, a certain percentage of them will start looking to move to retirement communities, probably, and there's nothing monolithic about any generation, but probably around the age of 80. The middle-aged boomer is 70 right now.
The middle-aged boomer is 70? Wow. I did just to say it like that. That's interesting.
Yeah. So that's, that's, I kind of know because that's my generation. And so we might, when you're asking that question, we might actually see more inventory coming on from the boomers later this decade or the beginning of the next decade. There's my 7-year thing that everybody will ignore again.
No,
but
no. This is for the record. We've got this. This is all part of compound media right now.
Yeah, and those homes will tend to be older because older people tend to live in their homes a long time and not well maintained at the end. But on the flip side, they're going to be in really good locations. So they're going to be close to where people want to live. So, we might see an interesting phenomenon here where house prices are somewhat flat for an extended period.
Mm-hmm. And what about so if you were thinking as an investor, not so much as a homeowner or even someone who owns rental property, are you interested in the market for these REITs that actually are creating housing for older people, whether it's assisted living or these, interesting move-up facilities? Is that something that you think has some legs?
I really haven't focused on that.
Yeah.
So
I'm fascinated by it.
Yeah, I would expect that there's going to be a lot of demand. My mom was living in a retirement community, and I actually been talking to them on a regular basis just to get a feel for what's going on there. And the marketing person told me that they're seeing more people in their 70s, younger than they used to be, moving in, and those people have been telling them they want to get in before the big wave hits.
Oh, that's so funny.
So we might we might see some real pickup in supply, maybe later this decade.
That's always interesting to me. So let's talk a little bit about new home sales. I mean, which are limited to some extent by land, and the state of domicile where these things are being built, because Bill was explaining to me how it's very difficult to build in many parts of California. I'm from New York, where we just don't have a lot of space. So let's talk a little bit about new home sales, and what does that tell you about the overall market, about how new homes versus existing homes? How do you focus on each, and what do each of those markets tell you?
Well, existing homes has been under more pressure. New homes, because they have tools that they can still sell. But yeah, I mean, the places where they build them, like in Texas, Florida is now under some pressure. California is a very difficult area to build a large number of new homes. I mean, there's still a lot of construction that goes on. We were talking earlier about ADUs, additional dwelling units. That's really been a big thing in California recently, but it's not a end-all solution. But we do have a lot of permits pulled the last couple of years on ADUs. So
I want to show you, guys, this is so fascinating to me. When Bill was saying, look, we don't have the same kind of credit shenanigans that we had in the last housing boom. This chart, and I love Bill's blog. I love his Substack because the man loves chart porn as much as I do. And this chart can just absolutely blow your head off when you think about what was going on during the bad times and what's going on now.
Yeah, this is from the New York Fed. They put out a quarterly report, and this is one of the charts they include in there. But it really shows the light blue is people with high credit. And in the most recent boom, basically everybody that was buying had really good credit. We don't see any of those yellow and dark blue at the bottom in the recent buying spree. But if you look back at the 2005 period, there were a lot of people with bad credit buying. When you look back at the housing bubble, we had all these loans, the ninja loans, no income, no job, no assets. We had, basically, if you could fog a mirror, you could get a loan. And one of the things that the mortgage industry had done was they used to use the 3 C's, credit, capacity, and whatever the third one is. But they switched to just FICO scores. And so then they would have all these programs that even if you had a low FICO score like they showed on here, you could still get a loan. So that's really that's what triggered me to really start digging into the housing market. And then when my friend Tanta joined and was writing with me, she's just an absolute expert in this area.
So when you look at where we are today, there have been some more, I think that some of the lending standards have loosened a tiny bit because a lot of people will not get that standard 20% down to get the best rate. Is that a mistake for if people are guiding their clients and you've got a young client and the client's like, well, I only have 8% down or I can put 5% down and get an FHA loan. Is there danger in that?
It depends on the client. So 3 C's are credit, capacity, and collateral. Sorry, I forgot about collateral. So, but I think it depends on the client. If the client can really afford the house, I don't see anything wrong with an FHA loan. It's true that FHA has a lot more delinquencies than other loans. That's just because they have looser standards.
Right.
So some of those people probably shouldn't be buying. That's the answer.
Do you think that we should be shifting this 20% down now that prices are up about 50%? Should we rethink that?
Well, you can get a loan with less than 20% down.
No, but do you know what I'm saying? Like as a mantra that we've grown up with.
Yeah, I don't think we need to stick with that. If you want to get the best rate, you put 20% down. But I think it would really depend on the situation. I'm not a stickler for 20% down at all.
That's very interesting to me.
Yeah.
I mean, especially living through the crisis.
Yeah.
I became more interested in it like as like a safe harbor for people, like just in case. But maybe I should be rethinking that.
Well, let's say you take out a 7-year ARM and you can afford the payment, if you can get in with 10% down, I mean, there's no real problem because it can't adjust for 7 years.
Right.
So that's totally different than what happened in 2004, 2005, 2006.
Yeah, I mean, because that was really like lending to anyone with no money down.
Yeah, no money down, you get cash out.
I know, right?
You buy with cash out.
Oh, by the way, what's going on with our equity right now? The ATM is closed. Is that what's happening?
For the most part, yeah. We used to joke that when people withdrew money out of their house, that was the home ATM. For the most part, it's barely open. We're probably going to see a little bit of pickup in cash out refis with lower mortgage rates because of the people that bought with 7% mortgage rates. They're probably going to refi, and a lot of times they'll take $20,000, $30,000 out or something.
If there's equity.
Yeah, well, those people probably, well, I don't know.
I don't know, like in the last year.
Yeah,
maybe not.
7%, yeah, they might not have much equity, so.
I made a typo on the next slide, but I want to put it up. It's so this is mortgage by interest rate, not credit score. So that's my bad. So credits. This is fascinating to me. So by interest rate, it's shocking, but about just under 60% of all outstanding mortgages are under 4%. Under 4%. And where are we now? 6.2 a bit ish.
Yeah.
Okay.
Somewhere around
And so, what is the rate at which you think we're going to start to see more activity? The people, someone who's got a 3% note who says, okay, I had 3 kids in the last 5 years. I need to move and I got to bite the bullet. Is there a round number? Is it a 5%? Is it just going below 6%? What do you think is going to happen?
Well, I don't think there's any perfect number. It's hard to go from 3% to 6%. And if, let's say you're out and you wanted to get 1 extra bedroom, it's hard to make it financial sense. But what does happen over time is those people's life needs will outweigh the financial difference. So if we get down into the 5s and time passes, somebody might be willing to give up the 3% loan. Of course, as Jill and I were talking, some of those people will, if they're doing okay, will buy a new house and keep the old one and rent it. So it might not increase the supply as much as we'd like. Right.
And I think that like when you're talking to somebody who's considering moving up, I think that the messaging is really, that 3% loan, you don't wait around for that. That's not coming back because Bill and I were also talking, like, if we're at 3% mortgages anytime soon, we're in a horrible recession. Bad stuff is happening. And so, because I'll just make you put your ass on the line here. Where you think we're going to be at the end of next year in the 30-year fixed? End of next year.
Somewhere in the probably high 5s.
And so you think it'll take until the end of 26 to get to 5?
I don't know. I don't know when we're going to get back to 5.
Who thinks we're getting back to 5% 30-year fixed rate mortgages, gang? Let's see a show of hands. Is that just wishful thinking? He's very positive. He's an optimist. He's a salesman. That's why.
Well, 5% is possible without a crisis. The one of the weird things is in 2020, we had really low interest rates, but most of the people that would be home buyers still had their jobs. And so, if we get into a situation where we're back well under 5%, that means we are in a crisis. And it'd probably be very different than the pandemic crisis.
What's like the long-term average going back to, let's say, 1976 or 7? If you think about a mortgage interest rate, if the average of Fed funds is 3, what was the average for?
Well, I think probably the median's in that 5 to 6% range.
So 5 to 6 would be like normal. Bill said something fascinating to me. He said, time passing is a very good thing. In the same way that time passing will sort of get us a little bit beyond this inflationary period, that timing passing from that sub 3% or 4% mortgage, which was very distinct and crazy, frankly. So when you think about how you look at the housing market, which, for a lot of people, especially early on, it's their biggest asset, right? That you're not waiting to perfectly time the market. So we talked about this also, that Bill said to me, there's no perfect time to buy a house. Because I said, would you buy a house right now? So that was one of the things that we talked about. And I want to also talk a little bit about rents. Can you explain why we use such bad data in the CPI report for rents?
It's not bad data.
Oh, okay, I'm just kidding. I'm just
kidding.
It's not exact.
Well, it's a different measurement than this graph is of asking rents. And, rents, we could go on for hours on this, but the rents took a big surge in 2021, which was kind of surprising because in 2021, house prices were really taking off because of all the demand. And so what that meant was something unusual was happening, is what we were getting is a lot of household formation. without minimal immigration. And in 2020, there was almost no net migration into the U.S. Why? Because of the pandemic. So why were rents taking off? Well, now we know that a lot of it was people splitting up. Roommates splitting up, people getting divorced, somebody go taking an apartment.
I spent a lot of time with you during the pandemic, and I've had enough. Kind of like that.
Yeah, and people were working from home. Yeah. Imagine two roommates. Hey, everything's great. Now we see each other all day. It gets pretty old. So we had this big surge in rents, which also, by the way, led to a big surge in apartment starts, because naturally people are going to say, hey, rents are going way up. Let's build apartments. But in the last year and a half or 2 years, asking rents have been kind of flat. This is for multifamily. It's still going up for single-family houses, but naturally apartment starts have dropped way off too. But the question she asked was, well, how come that isn't showing up in the CPI? And it is showing up, but slowly. So the CPI measures. They're not doing asking rents. They do a survey of people who rent houses, and so since rents are usually only increased once a year, it takes a whole year to catch up to all those rents. So if your rent just came up today, you might still see an increase, whereas asking rents might be down. And by the way, landlords tend to try to always increase the rents. So.
You're kidding.
Yeah.
That happens?
Yeah, depending on supply and demand, but they also know that tenants don't like to move. So yeah. So tenants kind of get the raw end of that one.
As always. All right, don't you hate when people throw your own words back at you? So let me do that with
Okay,
you.
Sure.
So, okay. Bill just recently wrote that we've had 12 months of year-over-year declines in apartment rents. I think you wrote that. The median rent is down $13 a month, 0.7%, since the peak of August of 2022. But rents are still 20% higher than they were in 2019. So rents actually are sort of moved with the inflation rate.
Yeah, and
right?
and the CPI measure of rents, which is primarily owner equivalent rent, is just catching up to that.
Yeah, you guys know about that owner equivalent rent, which it's such a weird part of CPI, because they say, well, how do we account for people who own a house if you've got a 3% mortgage? Not like you're. So they call people up, and the 6 people who answer say, well, what would your house rent for in this marketplace? How do they know that? That's nonsense, isn't it? Don't we have better ways to measure this?
People are trying. There are people who are kind of trying to substitute asking rents, because we do have some good measures of that, into the CPI, and it is really showing that the overall inflation rate is probably lower than what we're hearing, and that's probably why we'll get a nice rate cut tomorrow.
But I feel. Oh, you think they're going 50? Is that what you're saying? Right here, making news right here. Bill McBride.
It'll either be 25 or 50.
Oh, come on. What do you think?
I think they should go 50, but they could go 25.
But if they go 50, then they're going to be then the sad thing is they're going to be like, well, that's going to mean that we're really wrong. Who wants to admit they were wrong starting this late? I have a different question, though. If prices are up by more than 50% in the last 5 years, but rents are only up 20%, why shouldn't I just keep renting until those numbers come back into sync?
Good question.
I mean, really?
It really depends on your situation.
Oh, my.
I would much rather be a homeowner than a renter.
Why?
If I bought the right house.
Why? It's such a pain in the ass.
Because you get to control that. It's all under your control.
Yeah. Okay.
So I mean, I would much rather, and you're not gonna. You don't have to move if you don't want to. If the landlord does something. I'd much rather be a homeowner than a renter.
Okay.
If the cost was the same, I would definitely be a homeowner.
All right, now we're going to send these people off, and they need some help. Besides making sure that you check out Bill's calculated risk blog and his Substack, and it's really amazing, actually. And the charts are great. They're updated, all the time. You just got back from Africa, and you
Yes.
love that trip. And there's the big five of Africa, right? Lion. I had to look this up. I couldn't remember buffalo. Lion, leopard, rhino, elephant, buffalo. What's the big five of economic data that everybody who is in this business needs to understand? What are the biggest, five most important economic data points that these folks should know about?
Well, I would always say GDP, unemployment, or employment, unemployment. Those would be the top two, along with, I would go with home sales, especially new home sales and housing starts. That's four. And recently, I would go with inflation.
But not always?
No, most of the time, I wouldn't put that as a top five.
You're not a huge fan of confidence as a indicator.
No, I wouldn't. That wouldn't get into the top five at all. So I would have to think what would be.
What about retail sales, which you just got today? How important is that?
That's a key number.
Yeah.
Yeah, I don't know if I'd put it in top five. I mean, the top four I can come up with off the top of my head. I could say employment and unemployment, and that would give me two.
No, you're not allowed to.
Okay.
This is how I did it. I said jobs is one. So
Okay, jobs is definitely one.
I said jobs, GDP, housing, inflation, retail sales. Those were my five. Because I didn't let you do the cheat of new home sales and existing home sales. Which
I didn't do that. I said new home sales and housing starts.
Okay. Does anyone have any questions? I could go on for hours with Bill. So does anyone have questions? We'll take them, I guess. But if not, I'm going to keep asking questions. So I'm wondering, as you look ahead, what are the pressure points that you see for the housing market? What should people be aware of that is, worth monitoring?
Well, the first thing everybody looks at is mortgage rates.
Yeah.
So I would watch it. I'd watch supply. Especially in your local areas. If you're, it's funny because when people find out what I do, the first question I always get asked is, well, what's going to happen with house prices? And nobody can answer that. Nobody has a perfect crystal ball. Now, in 2005, I was saying, yeah, house prices might fall 40% in some areas, and people thought I was nuts. This year, I was comparing with another analyst. My forecast was house prices would go up 3 to 4% this year. I think his was a little lower than that. But if you ask me what's going to happen with house prices over a longer period of time, you never really know. The history of housing and land and real estate is booms and busts. That goes back long before the Case-Shiller index ever existed. So you hear about the South Seas land bust. This is something that's gone on forever, and it will continue. There have been times in my life when I've walked into an open house. I remember in 1996 in California, and I thought, darn, this is cheap. And so if you ever have that happen to you, that's probably a good time to buy.
And I'm going to give you one last question just on we heard about the surge of housing and prices in Florida and South Texas. And are the ones that went up the most ripe to see some moderation or even declines?
Well, there's certain areas that yes, Austin, Texas was a good example. Parts of Idaho where people fled during the pandemic, and now they're selling those homes, and so and those went up a lot. South Texas and Florida have particular issues, so and especially Florida because of climate change is really causing. And the first impact of climate change isn't so much the flooding and the damage from the storms. It's the homeowners, the insurance companies raising their homeowners insurance because they're afraid of the damage, and that's really what we're seeing today. So other areas that went up a lot, I don't see them dropping dramatically. So.
You heard it here. Bill McBride guaranteeing that your house price will go up by double digits over the next 5. All right, no, I'm just kidding.
I didn't say
I want to thank Bill McBride. You have no idea. This man is a legend. He is so smart. And go check out Calculated Risk. Also, check out, in case you haven't, we have Ben Carlson, who's been writing a lot about housing prices for the compound, and he's done some great work there. Thanks to all of you for joining us today, and we will see you next time.
And thanks to Jill. I really appreciate it.